When trying to manage your income to qualify for as much premium tax credits as possible, do withdrawals from retirement accounts count as income and work against you for premium tax credits? I've got that info and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Early in retirement, here's a scenario. If you retire before 65, one of the big hurdles that you've got to plan through and figure out well in advance, hopefully, so you're not caught off guard, is what are you going to do for health insurance? Lots of videos, lots of content about those choices, about how critical that decision is, about how you can approach it best from a planning standpoint. But you've got to figure that out. So what are you going to do for health insurance? So it's very common, if you've saved up a lot of resources, you've sacrificed, you're ready to retire at age 60 or 62 or 63, to then, okay, what do we do for health insurance until 65 when you can get onto Medicare? And healthcare.gov is an option. You might not like it, you might not love the choices, but going to healthcare.gov, which is the Affordable Care Act marketplace, that's where you could get insurance. That's one option. COBRA is another option. There's other choices too, but a lot of people turn to healthcare.gov, and especially if you're doing comprehensive financial planning and you've been doing that planning for a long time, likely your CFP is going to look there first or right away to see if there's an opportunity to manage your income in such a way that your income is low enough where you would get something called premium tax credits. It's a mouthful, because your income is low enough. If your income is below 400% above the federal poverty level, then you actually you pay a reduced amount for that health insurance you buy through healthcare.gov via what's called a premium tax credit, a credit that you get in advance. It all reconciles on your tax return, okay? So it all washes out. You could have to repay some, or it's just right, or you get some more credit added to your return, but you get it in advance because you pay a lower amount for the health insurance. So again, this is a common scenario. So let's think through this. You're 62, you're ready to retire, you're not eligible for Medicare until 65. COBRA is an option, but it's very expensive. What are your other options? And you might have some flexibility with making your income look a certain way because of the investment accounts you have. Therefore, you're working with your CFP, you go to healthcare.gov, you search up, find a plan, and you input your income to determine what your premium tax credits are. When you input your income, if you're retired, well, what sources of income are you going to have? Social Security. Recently did a video on this channel where it was, okay, well, does Social Security count in this? Yes, it does. Well, what if not all of your Social Security is taxable because the rest of your income is pretty low? Even if it's not taxable, it counts in this calculation. So, okay. Or even if you decide not to draw Social Security, if you're in retirement, you are likely drawing money out of retirement accounts. Maybe you have a pension, maybe you've got some other resources, maybe you're living on just a bank account. But if you're drawing money out of retirement accounts, and that's your income early in retirement, do you have to include that in this income calculation to determine whether you get these premium tax credits or how much you get? Well, let's go through the common ones. The first is a withdrawal from your IRA or a withdrawal from your 401k. First of all, if you're retired, I'd transition that 401k over to an IRA. There's lots of reasons for that. Work with your CFP and work through that. But withdrawals from your IRA or 401k, this is the most common. And yes, as you may have expected, that does count as income when you're looking at your income for premium tax credits or for the Affordable Care Act, healthcare.gov. And so therefore, when you're going to that site and estimating, well, how much will my health insurance be? You've got to know how much do you think you're going to be withdrawing out of your IRA. And so this is definitely not a scenario where you're going to say, you know what? We probably only need $4,000 a month out of the IRA, but let's take $5,000 instead just to make sure we've got a cushion. No, this would be a scenario where Not that you want to retire and live really lean, but you want to be very clear that you don't take more out of your IRA than you otherwise should. Otherwise, your income's going to be, or otherwise need to, otherwise your income's going to be higher, and that's going to limit and restrict your premium tax credit. So withdrawals from IRAs, traditional IRAs, or 401ks, yeah, that's going to count as income. What about Roth IRAs? Thankfully, guys, Roth IRA withdrawals do not count as income towards your premium tax credits. I wouldn't be surprised if they change this rule at some point. And I've had to look, as I get this question from time to time, or our team of advisors get this question, we look just to verify, hey, the IRS hasn't changed this yet, right? Where it wasn't notified, it wasn't kind of publicized. Because I wouldn't put it past them to say, no, even though a Roth IRA comes out tax-free, you're going to have to report this. They haven't done that yet. So therefore, you're going to want to make sure that you do qualify to have your withdrawals from your Roth be tax-free. And that qualification is that you've had a Roth IRA for 5 years. Doesn't need to be the same one, doesn't need to be consecutive, just a Roth IRA for 5 years, and you're age 59 and a half. If so, Roth IRA withdrawals, or the growth, is not taxable and therefore does not currently count towards the income threshold for premium tax credit. So this would be a way, even though the desire, and oftentimes what's best is delay withdrawing from that Roth IRA as long as possible. Let that thing grow, tax sheltered, tax deferred, tax free. This might be the scenario where you would supplement some of your income from your Roth so that it doesn't infringe on the premium tax credits you'd get. What about a pension? A pension isn't something that you're withdrawing from, it's just automatic income that you're getting, and yes, that is income as well. So when you're factoring in what your income is going to be for premium tax credits and at healthcare.gov, any income you're getting from your pension, you're going to want to include that. The first year when you sign up for your pension, if you get some sort of backdated amount or a little bit of lump sum amount, you're going to want to include that in there. It's all going to count as income. You're going to want to have that reflected accurately. And then finally, what about non-retirement accounts? If you're drawing money out of those, does that impact your income for premium tax credits? Yes and no, or let me say that differently. No and yes. A withdrawal from a savings account, a withdrawal from an investment account in and of itself is not taxable. So that's good news. And oftentimes when we're doing this creative planning for folks, because we do this a lot, where people are getting premium tax credits early in retirement, they're drawing out of a non-IRA type of account, whether that's a bank account or just an individual joint account, trust account. And those withdrawals are not in themselves taxable, but the activity in those accounts are taxable whether you withdraw the money or not. The interest you earn on the bank account, yep, that's going to land on your tax return. That's income. Capital gains, dividends, those sorts of things, whether you draw that out of the account or whether it just happens organically in the account and stays there, it's going to land on your tax return, and it's going to impact whether you get premium tax credits or not. Quick example, have an individual that early in retirement was living off of a savings account and an individual account and had some dividends, interest, and so yeah, he was getting some premium tax credits, but not as much as we otherwise would have wanted, simply because of all these dividends, this dividend and interest. Well, he just received an inheritance, and that sizable inheritance, and he's blessed to receive it, and sad by the passing, but now that means the interest and dividend is going to be so much higher that he's no longer going to be eligible for premium tax credits. Whether he takes the interest and dividends out or not, or leaves them reinvested, it's going to land on his tax return, influences this calculation. So that's how retirement accounts impact your income in determining and influence whether you're going to get premium tax credits or not. Work with your certified financial planner. This, retiring early before Medicare, trying to qualify for as much premium tax credits as possible, the proactive tax planning, draw from IRA, draw from Roth, draws from other accounts, those are precisely the reasons you need a comprehensive financial planner or comprehensive financial plan from a certified financial planner, looking at all 6 areas of your financial life, your health insurance, your taxes, your cash flow, your investment, your retirement, your estate plan, looking at how all 6 of those intersect to determine, all right, what's the wise thing to do. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.